Ever wondered how to make money when the stock market is going down? A stock market correction is a term you may have heard, and it simply means the market has tumbled by 10% from its recent peak. Now, if things get a tad more severe and the downturn sticks around longer, well, that's what we call a recession. In these tricky times, you might be thinking, there a way to turn the tide in my favor? Well, one strategy to consider is selling put options on major index ETFs. Don't forget to hit that subscribe button for more informative content just like this. Give us a like if you found this useful, share this with your friends who are looking for ways to handle a market downturn, and hit that bell icon to get notified about our latest videos. And of course, if you want to learn more about options selling safely, be sure to leave a comment below. This video is for educational purposes and is not professional financial advice. All viewers are advised to conduct their own research or consult a professional before making any financial decisions. First, let's get acquainted with put options. Just like a game of poker, the stock market is full of strategic moves, and one of these moves is the use of put options. In the simplest terms, a put option is a contract that gives the investor, let's call him Jack, the right, but not the obligation, to sell a specific quantity of an underlying security. This could be a stock, an exchange-traded fund, or even an index. Jack can sell this at a predetermined price, known as the strike price, within a certain time frame. Now imagine Jack has a put option for Company X, which is currently trading at $50 per share. Jack's put option allows him to sell shares at $45. If Company X's stock price plunges to $30, Jack can still sell his shares at $45, thanks to his put option. Jack, my friend, is in the money. But what if you're on the other side of the table? What if you're the one selling the put option? Well, when you sell a put option, you're essentially taking on an obligation. You're saying to Jack, if you want to sell your shares at the strike price within the option's time frame, I'll buy them. So if Company X's stocks plummet to $30, and Jack decides to exercise his option, you're on the hook to buy those shares from him at $45, $15 more than their current market value. That's a significant risk, but it's a risk that could come with significant rewards too. In essence, when you sell a put, you're betting that the stock price won't drop below the strike price. You're wagering that the stock will hold steady or even increase in value. And if you're right, you pocket the premium from selling the option, and Jack's put ends up worthless. But remember folks, the stock market isn't a casino. It's a game of strategy, and understanding the rules is key to playing well. So, when you sell a put, you're betting the stock price won't drop below the strike price. Now that we've established what selling puts is, let's dive into the risks. You see, the world of selling put options can be a bit like a roller coaster ride. It's thrilling, it's exciting, and it can be a heck of a lot of fun. But just like any roller coaster, it comes with its fair share of risks. One of the main risks associated with selling puts is the potential for significant losses if the market takes a nosedive. Imagine you've sold a put option with a strike price of $100, and the market price plummets to $50. You're obligated to buy the stock at the strike price, which in this case is twice as much as the current market price. Ouch, that's gotta hurt. It's a bit like buying a brand new car, driving it off the lot, and then watching its value drop by half. You're stuck with a depreciating asset and a hefty price tag. Not exactly the kind of ride you were hoping for, right? Another risk of selling puts comes from the possibility of a margin call. This is when your broker requires you to deposit additional cash or securities into your account because the value of your account has fallen below the broker's required minimum. It's like getting a call from your credit card company saying you've maxed out your card, and they want their money now. Talk about a buzzkill. And let's not forget about the opportunity cost. When you sell a put, you're locking up your capital until the option's expiration date. This means you might miss out on other potentially profitable investment opportunities. It's like turning down a hot date because you've already committed to a night in with Netflix. So yes, selling puts can be a high-stakes game. It's not for the faint of heart, and it's certainly not for those who aren't willing to take on some risk. But like any good roller coaster, it can also be a thrilling ride with the potential for great rewards. Remember, the potential loss can be substantial if the market plummets. So buckle up, keep your hands inside the vehicle at all times, and enjoy the ride. It's not all doom and gloom. There are benefits to selling puts. Let's dive right in, shall we? The first and most immediate benefit of selling puts is that you receive the premium upfront. The moment you sell a put option, the premium is deposited into your trading account. It's like selling tickets to a concert before the band even starts playing. You get the cash regardless of whether the concert is a hit or a flop. That's a pretty nice perk, wouldn't you agree? Now, this does not mean you're out of the woods yet. This premium is your compensation for taking on the risk of potentially having to buy the stock at the strike price, even if the market price falls below that level. But hey, who said there's no such thing as a free lunch? This brings us to the second benefit. If the market does take a nosedive and the option is executed, you get to buy the stock at a lower price. It's like walking into your favorite designer store and finding everything on sale. You were willing to buy the stock at the strike price, so getting it at a lower price is just icing on the cake. But here's the kicker. Even if the option gets executed and you have to buy the stock, you still get to keep the premium. Remember the concert analogy? It's as if you sold the concert tickets, the concert was a flop, but you still get to keep the ticket sales. Not a bad deal, right? So, to sum it up, selling puts allows you to pocket the premium up front, and if the market plummets, you may get the opportunity to buy your favorite stocks at a discount. However, remember that like all trading strategies, this comes with its own set of risks, which we've discussed in the previous scene. So, the prospect of earning premiums and potentially buying stocks at a discount can make selling puts an attractive strategy during a market downturn. But how does all this play out in a market correction or recession? Well, let's dive into it. Picture a market downturn, where stocks are tumbling and investors are scrambling for safety. This is where selling puts can become an interesting strategy. It's like setting up a lemonade stand in the middle of a heat wave. There's a demand, and you're there to supply. You see, during a market correction or recession, investors are more likely to seek protection for their investments. They're willing to pay higher premiums for put options, which offer them the right to sell their stocks at a predetermined price. This is where you, as a put seller, step in. You're essentially offering an insurance policy. You're saying, hey, I'll buy your stocks at this price no matter how low the market goes. For this promise, you receive a premium. The higher the fear in the market, the higher the premium you can command. But remember, with great power comes great responsibility. If the market really tanks, you're obligated to buy those stocks at the agreed-upon price, which might be significantly higher than the market price. That's your risk. However, if you're confident that the market will rebound, then this could be a fantastic opportunity. You're essentially being paid to wait. If the market recovers, you pocket the premium without having to buy the stocks. If the market continues to fall, you buy the stocks at a discount, plus you keep the premium. It's like having your cake and eating it too, with one condition. You must be patient and willing to weather the storm. You must be confident that the market will eventually rebound, and you'll be there to reap the benefits when it does. In essence, selling puts in a down market can be like being paid to wait for the market to rebound. So, the next time the market takes a dip, instead of panicking, consider selling puts. You might just find that it's a profitable strategy in troubled times. Let's wrap up what we've learned about selling puts in a market correction or recession. We've embarked on an enlightening journey, exploring the intriguing world of put options. We've discovered that selling puts is all about agreeing to buy a stock at a set price, betting that the stock won't drop below that value. It's like being the insurance company of the stock market, providing a safety net for nervous investors. We've also delved into the risks associated with this strategy. Remember, it's akin to playing with fire. If the market nosedives, you could end up buying stocks at a higher price than their market value. It's like throwing a party and nobody shows up, but you're still stuck with the bill. Yet we've also seen the silver lining, the benefits of selling puts. In a market downturn, it can serve as a source of income, like a lemonade stand in the middle of a desert, quenching the thirst of parched investors. It can also be a way to acquire stocks at a discount, like snagging that coveted designer bag during a sale. In essence, selling puts in a market correction or recession can be a viable strategy, a dance with the bear market, if you will. But it's not a move for the faint of heart. Remember, while selling puts can be profitable in a down market, it's important to understand the risks involved and always invest responsibly. As we continue our journey through the world of selling puts, it's crucial to stick with major index ETFs. Now you might be wondering, why is that? Why not bet on individual stocks? Well, here's the thing. Individual stocks are like wild horses. They can gallop towards the sky or plunge into the abyss. They may never rebound, or worse, they may sink completely. It's like betting on a one-man show. If the actor forgets his lines, the entire play is ruined. On the other hand, major index ETFs are more like a well-rehearsed orchestra. Each instrument plays its part, contributing to the overall performance. Even if one instrument goes off key, the others can still carry the tune. Major index ETFs are more likely to rebound after a market downturn. They represent a basket of stocks and therefore spread the risk. It's like investing in the entire football team rather than just the star quarterback. By selling puts on major index ETFs, you're betting on the overall market rather than individual stocks. It's like betting on the entire casino, the house, rather than a single player at the blackjack table. And as the saying goes, the house always wins. So remember, when selling puts, it's safer to bet on the house, the market, than on the player, individual stocks. It's all about playing the odds and reducing risk, because in the end, we're all just trying to make it through the roller coaster ride of the stock market, with our funds intact and our spirits high.